I'd like to tell you about a free app that I've been using from Enverus Energy Link called Mineral IQ. Mineral IQ enables you to view monthly income, track earnings trends, and download pay stubs. It also provides in-depth valuation information you can use to make confident decisions when to sell or what to buy. It even tracks surrounding rig and permit activity and provides you with that data on a weekly basis. One Mineral IQ user said, "I had just inherited some income on a well, and Mineral IQ's appraisal feature gave me the confidence to hold on to my interest instead of selling it at the wrong price." If you aren't already signed up, be sure to visit www.mineraliq.com today to get started. Again, that's Mineral IQ to get started for free today. And I would encourage everyone to check it out. I've been really impressed with the Mineral IQ platform. And since it's free, what are you waiting for?
Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
My name is Matt Sands, and I'm here to help you make the most of your minerals and royalties. And I'm joined by my co-host, Justin Williams. We're here to dive into tax strategies for the end of the year. Justin, it's that time of year where we ought to be thinking proactively about how do we do things before the end of the year, make some moves to potentially save taxes when it comes to file in April. So no matter what tax bracket you're in, there's always things we can be doing to minimize our tax liability.
You nailed it, Matt. And we've talked a lot about depletion deduction, and we were talking about this before the show. We've talked a lot about tax strategies specific to minerals, but we've never really taken a step back and talked about, okay, as a mineral right owner, if you've got income coming in, how do you defer or how do you minimize that tax liability to some degree? And so we're going to kind of take a deep dive on that, which I think is great information for people looking at everything holistically.
I think that's an important thing to think about because a lot of times minerals and royalties isn't the only asset that we own. Most of the time we have other investments, whether that's your retirement account, whether that is an investment property that you have, a rental property or something like that. And so the minerals and royalties part of your portfolio may only make up a small portion of that. And so when you think about your tax liability, the IRS doesn't care where you get the income from. They just want their share. And so when we make decisions related to minerals and royalties, we really need to think about, how does that fit into our overall tax picture? And we'll dive into those strategies. And that kind of leads us into the first one, Justin, about deferring your income. Do you want to talk about that?
Let's do it. And this is something we often hear, and it's not bad advice at all. And so deferring income, when you're talking about that, you're really talking about pushing tax liability to the next year, maybe in a year where you had a higher than normal income. You're expecting maybe a significant bonus payment from leasing your mineral rights or whatever it is. With the scenario of a bonus payment, asking that operator to wait until after January 1st so that goes into the next year's tax is definitely something to think about, Matt. And as you mentioned, if you had a really great year of pay in your job, maybe this year is not the time to sell those mineral rights and to kind of keep your tax liability as low as you can. And Matt, this is something I think applies to all investments and all income types and just good advice.
Yeah, that's a great point. And, like Justin said, that lease bonus payment, it goes and mixes in with the rest of your ordinary income because it's taxed as ordinary income. If you have a big mineral portfolio and all of a sudden, they're going to drill here soon and you got offers to lease, this year maybe you had, a record year in terms of sales or whatever it was, and you have higher income than normal. If you lease your minerals this year and you deposit that lease bonus payment, you're paying taxes in the current calendar year. And if you're able to defer that to next year, maybe when things are a little bit different in terms of your tax bracket, then that marginal income that you get from the lease bonus payment will get taxed potentially at a lower rate next year. So in the long term, you want to keep as much in your pocket as possible. And maybe by spreading those events out over time, you can do that. So that's one potential strategy. And of course, before we get too far into this, we have to say this should not be construed as legal or tax advice. Absolutely, you need to get with your CPA, with your financial advisor to determine what makes the most sense for your particular situation. We're just providing this for informational purposes. There's potential things you could think about. And so we're just going to be talking about these in general terms. But again, they may or may not be applicable to your situation. So keep that in mind. So, Justin, what about capital gains taxes if you sell mineral rights? Is that something that falls into a different bucket? How do we need to think about that?
Right. Yep. Capital gain tax is kind of its a beast of its own. And that tax rate on most net capital gain is no higher than 50% for most individuals. Some or all of the net gain may be taxed at 0% if your taxable income is less than or equal to whatever it is for that year, Matt, which it happens to be just over 41,000, and then 83,000 for married filing jointly, and a capital gain rate of 15% applied to the taxable income if you're in that most common bracket, which for the year that we're talking about is just over 41,000 to over 450,000. But if you get into the higher brackets, then your capital gain tax rate can be 20%. And that applies to the extent that your taxable income exceeds that threshold for the 15% capital gains rate, Matt. And in minerals, this is something we hear about all the time because it's so common for somebody to inherit mineral rights that didn't have a cost associated to it. And then if they sell it, they're kind of in a situation to where they're either facing this 15 or 20%, and they've got to come up with an amount to try to decrease that. And so capital gains tax is very real for mineral owners.
Yeah, it's very real. But I guess on the bright side, when you think about the overall tax that you pay on that asset, if you sell it, you end up paying less in taxes potentially over the life of that asset. When you think about a 15% tax rate as compared to ordinary income. So that's something to think about.
You nailed it, man. And kind of tying back to the thought we were talking about, you can really help yourself in planning. If this year, again, has been a record year for income, maybe holding off and pushing through the sale of those mineral rights, that next year would really help to keep this capital gains tax rate down, as well as your tax rate from the income bracket that you're going to fall in. And Matt, that kind of brings us to the next topic here, which is offsetting gains with losses from investments. So mineral right owners, mineral rights are not their only investment type. And when you're exploring other investments, it's certainly something that you can kind of offset that. And Matt, this goes into a strategy that's often called capital loss harvesting.
So yeah, if you have the situation where maybe you have some stocks that are down and you're planning on selling them anyway because you don't want to hold them for the long term, then maybe it's a good time to sell to capture that loss to offset other gains. And when you think about other capital gains, we talked about mineral rights, where if you sell those interests, you would pay either a 15% or 20% long-term capital gains tax rate, assuming you've held on to them for more than a year. And so in that situation, you could potentially offset some of the tax liability from the sale of your minerals by selling stocks that are down, in your brokerage account. And of course, this needs to be part of a holistic plan that you get with your financial advisor to see what makes sense. But if you're planning to sell the stock anyway, some advisors will say, well, maybe consider selling it this year, harvest those losses, and to offset some of that other gain. Now, if your losses are greater than your gains, you can deduct up to 3,000 of those excess losses from other income. At least this is in tax year 2023. And if you have more than that, you can potentially carry it over to the next year. But these numbers are always changing, so be sure to get with your CPA to figure out what the current limits are. So that's definitely another option. And when we talk about deductions, so we think about the income that we have, we always want to try to maximize our deductions. And with recent changes made to the tax code, most people benefit from taking the standard deduction, but there are some last minute tax deductions that we might think about taking, or at least be making sure that we're taking. And the first one of those that is one of the benefits of owning royalties is the depletion deduction. And we talk about this in a lot more detail in episode 105, where we talk about all you need to know about the depletion deduction, how it's calculated and all of that. But talking about depletion deduction, that is definitely a tax deduction that all royalty owners should be taking if you're receiving royalty income in the current tax year. And this is because oil and gas assets are a depleting asset. They call it a wasting asset according to the IRS. And that is because the quantity of the oil and gas that is in the reservoir is finite. And as it's produced and removed from the deposit is depleted. And the depletion deduction is like depreciation with other capital assets, like we've talked about in the past. So, definitely something to make sure that you're taking advantage of and get with your CPA if you're getting royalties to make sure that you're taking advantage of that depletion deduction. There are two different ways you can do that: cost depletion and then percentage depletion. And again, go back and listen to episode 105 as we go into more detail about how that is calculated. In general, most people just take the percentage depletion because it's just a 15% deduction off your annual gross royalties. And it is easy to calculate. The cost depletion requires you basically get a professional appraisal so that you can understand what the total reserves are with your interests. And then you get to deduct the amount of those reserves that are produced in that year. So get with your CPA to figure out which method is most beneficial to you. Again, most people end up taking the 15% deduction just because it's easier to calculate. And you can continue to take the depletion deduction after you've basically depleted the full basis of that asset. So that's a nice benefit. Now, of course, the IRS wants to potentially recapture that if you sell the asset ever, but something to think about.
Absolutely, Matt. And something to mention with this too is it doesn't apply to lease bonus or delay rental income, only the aspects which are the depletion of the asset, which is production. And like you said, it's really great for mineral owners and certainly something if you're looking for a CPA to be sure that they have an understanding of that if they're going to be helping you with your taxes as a mineral owner. All right, Matt. So another option is to contribute the maximum to retirement accounts. There's a lot of tax advantages for retirement accounts for mineral owners and for anybody. And you can max out your contribution limits, and that can really help to decrease your tax liability. That's certainly something to get with an advisor and see what options you have available to you. But that might be a good option if you have a year of high income, is to fully fund and reach the contribution limits you have on any retirement accounts to help kind of ease that tax burden. And Matt, kind of circling back to a little bit what we talked about before, capital gains tax is typically tied with the selling of those mineral rights for mineral right owners. And we mentioned that a lot of times those are inherited minerals. And so if you're looking at selling, you really want to be sure that you're paying the least amount of taxes as possible. And the way to do that is to have a stepped up cost basis with the minerals that you inherited. You have to have an idea of what the cost has increased since you received those rather than going from a $0 amount, Matt. And I know in the evaluations you do, this is what a lot of your clientele is trying to solve.
Yeah, exactly. The step up in cost basis with inherited minerals is a big benefit because especially if you've inherited minerals, I would say in the past 10 to 15 years, potentially with the shale revolution and horizontal drilling, the value of those interests may be significantly higher when you inherited them than when your ancestors originally purchased them or, owned them. So that can be a powerful tax strategy because your net capital gain is calculated based on the amount you sold your minerals for minus the cost basis. And if there were wells planned and when you inherited them, you probably had a lot of value in those interests. And so you would not have to pay in that situation the full amount of the sale. You'd basically get to subtract the value at the time of inheritance from the value that you received when you sold them. And then you'd pay tax on that difference. In other words, the net gain. And in order to establish what that basis was, you have to get a look back appraisal or what's called a retrospective appraisal. And basically, that's just where the appraiser looks back in time at when you inherited them and seeing what type of activity was going on and then what the value of that asset was at that time. And so, again, that is definitely something to think about. And, if you are selling or planning to sell, you'd want to be proactive because it takes some time to do that appraisal. And so you'd want to be looking for somebody who could do that for you. That is something that I do for clients as well, but definitely not something you want to call them up on April 1st saying, hey, I need a look back appraisal. I need to file my taxes. The time to do that is either when you sell or ideally before to understand the value of those interests before you sell it.
You nailed it, man. And, something worth mentioning too, when you're talking about taxes is ensuring that your operator is up to date on your W-9 or however you want them to be paying you. And there's different advantages to having minerals in an LLC, having minerals in a trust as an individual. And those are all something that it takes the mineral owner taking action with the operator to change the ownership if that's what needs to happen. And so that's something really worth mentioning is make sure your operator knows how to pay you and is paying you properly to where you can get the most tax advantage from whatever structures you have set up. And then last but not least, this is actually one of my least favorite things in the world is estimated tax payments. It's bad enough when you have to pay tax at the end of the year, but then when the accountant gives you the printouts of all the other payments you're to make, but it makes a huge difference. Many mineral owners find themselves at the end of the year with a huge tax bill if you had a high income from mineral rights. And the way around that is ensuring that you're making quarterly estimated tax payments to the IRS throughout the year. And then at the end of the year, you're left with a tax liability that's much smaller. And that really can help mineral right owners and keep you from getting into a situation to where you didn't save properly because life happens and sometimes it gets out of hand.
Yeah, that's a good point. And that ties back to that W-9. If you don't give your tax ID to the operator, they will withhold federal income tax, and they're going to do so at a standard tax rate, typically 28%. And they call that sometimes backup withholding. So if you see a significant amount being held back from your royalty checks and it shows up under federal income tax or backup withholding, that's what that is. And that's because they don't have your social security number or the tax ID of the entity that you hold the minerals in. So you would need to send them a W-9, provide your tax ID number so that they can report your royalty income to the IRS. And that is in general a beneficial thing to have that set up because then you're in control over what you do with that money throughout the year. Now, like Justin said, you need to plan for potentially making estimated tax payments if your royalty income is a significant part of your overall income. And so you should talk with your CPA in that situation, and they can help you calculate how much you should be making in those estimated tax payments so that you don't get hit with a tax penalty for underpayment when you go to file your taxes. So that is an important thing to think about. And if you are in that situation where you do have a significant amount of royalty income, that's like a majority of your income, then it is important to get an accurate feel for what your royalty income is going to look like for the year. And that's pretty straightforward to do if you're a subscriber to Mineral IQ. They provide a forecast of your net oil and gas volumes, each month into the future for the life of the wells that you have. And so in that case, all you would have to do is simply multiply those numbers by the expected oil and gas prices, for the next year, for example, to get a forecast on your monthly royalty payments. And you can provide that to your CPA, and then they can do the calculations to help you make those estimated tax payments. If it isn't something where your royalties are a significant part of your income, then it may not be something you need to do. But again, talk to your CPA. They can advise you on what actions you should be taking to minimize your tax liability. And part of that is avoiding penalties. So it's definitely something to think about. And, last thing I'll say on this, kind of related to the whole tax aspect with royalties, is the 1099 that you receive at the end of the year. You should be checking that against your royalty statements to make sure that the gross royalty amounts on your 1099 that are reported to the IRS match what you were actually paid and what shows up on your check stub. This quick end of year audit is something we go over in more detail in episode 166. So definitely check that out. I have a free worksheet you can download that'll help you calculate this and to make sure that you're getting paid correctly and getting taxed correctly, because it's a pain if they report that incorrectly to the IRS. Then you have to go and get that reconciled. It's great to just have that done as soon as possible when you get your 1099 so they can correct it if they need to before you file your taxes. And like I've mentioned before on previous shows, it's not uncommon to get a corrected 1099 from your operator.
Yeah, not at all, Matt. And, often this happens without the prompting of the mineral right owner, but I've also discovered mistakes and had to go back to the operator and they issued me a corrected 1099. So it's certainly something to take a look at. Kind of talking about selling a mineral rights again on this topic. If you are facing a well, which is going to be drilled and you're going to have a significant royalty income the next year, an option that you have is to look at potentially selling your inherited mineral rights and paying your capital gains tax, which may not be much if you have that step up in cost basis, which we discussed earlier. And that would allow you to take that money in the current tax year and kind of defer that income that's going to be coming over the next year. And Matt, this can make sense if it's going to be bumping you up to a higher tax bracket and, each additional dollar of income is going to be taxed higher. It's just one of those things to kind of look at and balance. And this is certainly something to discuss with your CPA. and see kind of what they have to say, but certainly an option as well to kind of defer maybe the increase in the higher tax bracket that could be coming and result in just a higher tax rate for you.
Yeah, for sure. And if you're expecting, again, that significant amount of royalty income to where it's going to bump you up to a higher marginal tax bracket for that additional dollar that you get in royalties, definitely you're going to be paying more in that situation. And so then maybe more strategic move would be to sell a portion of those interests and capture that step up in cost basis, like we mentioned earlier. And then, first of all, you're paying a lower tax rate by paying capital gains taxes versus ordinary income, which again is typically 15% for most people, against, potentially 28%, 30% plus. So that would help reduce your tax liability. And so again, at the end of the day, what we're thinking about is how are we going to minimize our overall tax liability for the life of that asset? So that could be one potential strategy. So, it's important to keep in mind that the value of those royalties that you'll receive over the life of those wells would be higher than you would get when selling. But again, due to time value of money, you may actually be able to reinvest that into something else and exceed the value of those royalty payments that you would have gotten, especially if oil prices fall, which I think kind of brings us into the next one, Justin.
Yep, you said it, Matt. And deferring capital gains taxes, there's some options available to you. And I think the most commonly used one is what's called a like kind exchange, or more commonly known as the 1031 exchange. And the 1031 exchange allows the sale of one property to purchase another similar property. And that may be other mineral rights, or that might be other real estate. And that's because a mineral right is a type of real property. And Matt, that really can help decrease the tax liability or the capital gains tax that comes with selling mineral rights. However, there's very specific timing and guidelines that must be followed with the 1031 exchange in order to qualify for that tax deferral. And it's really important that you follow those rules. Otherwise, you'll still have the capital gains taxes on the net gain at the end of the day. But Matt, this is employed all the time in the real estate world for switching of investments and helping to defer that tax liability.
Yeah, that's a great point. And we covered that in a lot more detail in episode 54. And like Justin mentioned, there are very specific time requirements and, you have to reinvest the full amount. Otherwise, you have to pay taxes on the difference between the sale of your minerals and the reinvestment in the other property. So you have to be very careful. If you are planning on doing this, it requires some, upfront planning to identify the replacement property and all the things. So it's definitely something to think about, but it's a great way to defer capital gains taxes in that case, and you can reinvest. Perhaps you're very heavily weighted in your mineral and royalty portfolio, and that makes up a significant portion of your overall assets, and your financial advisors, telling you should think about maybe selling some of these minerals and buying some other type of investment property. A 1031 exchange might be a good fit in that situation. So it's a very powerful strategy. And again, savvy real estate professionals use this all the time. It's something they just keep rolling over these investments into something new and deferring those capital gains into the future, keep on doing it forever, I guess, and you wouldn't have to pay it. But, it is something that is a very powerful tool. And, whatever the case, I think this kind of falls into the conclusion here in that we talked about some of these strategies that may make sense, but always check with your financial advisor, with your CPA, to see if these are actually a good fit for you. So just any thoughts here before we wrap up?
I think something worth mentioning here is, as a mineral right owner, especially if you're looking at a significant income, building your team of advisors, such as having a financial advisor, or having a good CPA, both of which are aware and understand minerals, at least to some degree, is hugely important, Matt. And I know that early on, this was something I really struggled with because not every CPA knows minerals intimately. And that's something that you really have to kind of find the right person. And having this team is just hugely valuable, Matt. And I talk to you a lot and rely on you a lot for the evaluations and questions about that. And having those people that you can rely on, I just can't stress enough for mineral owners how important that is. So if you don't have that in place, before you really go gunning for any of these tax strategies, go seeking a good advisor that can help you through this. Because as we mentioned through the shows, there's all kinds of details and caveats that may or may not apply to any individual's situation.
No, that's a great point. And that's ties into the interview that I did with Jared Matchin with Brownlee Wealth Management, talking about financial planning and the kind of holistic view that a good financial planner will provide. And so that's definitely something, especially if you're getting a significant amount of income from these types of assets, there are opportunities to be strategic and to make the most of that, as opposed to just being reactionary and paying whatever taxes occur from, deciding to sell. So whether that's deferring income like a big lease bonus payment to strategically optimize your tax liability, especially if you're on the brink of being in a higher tax bracket, to again, looking at offsetting gains from sale of minerals with losses from other investments, which we don't really ever talk about. We're very focused on minerals and royalties on this show, but we realize that these assets are part of the bigger picture, which could be your 401k, could be your brokerage account, could be, again, rental property. And thinking about your minerals and royalties holistically and how they fit into the overall tax picture is something that we really wanted to focus on, because decisions you make today related to your minerals and royalties can have a knock-on effect on your tax liability that maybe you didn't intend. And if you had shifted the timing of something, whether it's leasing or selling, then you could have minimized your taxes. And again, just to echo what Justin said, getting a good advisor in your corner, you can bounce these ideas off, or they can perhaps bring these up as potential options so that you're making the most of your minerals or royalties is a huge asset. So be sure to, get that going. We have time before the end of the year. We're recording this in October of 2023. In the end of the third quarter, beginning of the fourth quarter is a good time to be thinking about these strategic tax planning strategies to minimize your taxes. And again, like we said before, don't construe this as legal or tax advice. This is provided for informational purposes only, just to get the thought process going so you can have these conversations with your tax advisor to make the most of your minerals and royalties. So we'll link to the resources that we mentioned in this episode and the show notes, which always can be found at mineralrightspodcast.com. So till next time, thanks, Justin.
Well,
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.